Tariffs. A tariff is a tax on imported goods. Imported goods are products being brought into the country from another country. For example, coffee being imported into the UK from Costa Rica, whereas exported goods would be the UK selling items such as machinery overseas to another country. A tariff is very clearly a barrier to trade, as it effectively places a tax on these goods and services coming into the country from another. This makes these foreign goods coming from other countries more expensive than the ones made and sold domestically in this country. By making these products more expensive, this is a barrier to international trade, as it makes goods from abroad more expensive and less competitive than products that are sold in this country. Let's take a look at a very simplified example. Let's say the cost of a car made and sold in the UK is £20,000. Let's also say you can purchase an imported car from Japan for £18,000, saving you £2,000. However, the UK government decides to place an import tax of 25% on Japanese cars. This would now make the £18,000 car cost £22,500, meaning that it would now be more expensive than the UK car. This example in theory would mean demand would drop for the Japanese cars and in turn put a barrier in the way of international trade, as demand for imports would drop. Tariffs are also used to promote and protect businesses in their own country and make the option of importing more expensive. So what impact do tariffs really have? Tariffs do have their advantages and disadvantages, and although it can limit international trade, there are reasons governments use tariffs. One of the most obvious advantages is that it means domestic products can compete with foreign alternatives, where production costs and labour is usually cheaper. A tariff makes the goods equal to or cheaper than international competitors. An obvious benefit for the government is that it increases their revenues, as tariffs are paid directly to the government. An argument often touted by politicians who advocate tariffs is that it protects jobs, especially in manufacturing, where tariffs discourage companies moving manufacturing overseas and in turn saving jobs. However, there are downsides to tariffs. Ultimately, tariffs make goods more expensive for the end consumer. We buy products affected by tariffs every day. Food, clothes, cars and electronics usually all have tariffs placed on them. Another disadvantage is tariffs are rarely one-sided, and if one country imposes a tariff on another country, then they often retaliate by putting tariffs on their goods. And finally, the counter-argument is that jobs are often lost elsewhere through tariffs. So for example, in the export industry, where if the country is exporting less, jobs in exports will decrease. What is clear is that tariffs can definitely act as a barrier to international trade, but depending on your perspective, you can see them as a good or a bad thing.